I'm not actually sure if we have anyone that is solely an English speaker in the audience. No, not really, but I will still have to speak or want to speak in English because that is the terms that we've set for this discussion. My name is Eva Gonçalves. I work here at the National Bank of Slovakia, and it is my pleasure to welcome you to the second Megatrends talk. This setup or this talk is something that the National Bank of Slovakia cooperates with the Institute of Banking Education, which is a non-profit organization set up by the bank to bring you things like Megatrends and to give you a little bit more insight in what we do at the central bank via education and educating people from the financial sector, but also a broader audience. So for our second talk, we have come with a presentation on the future of commercial real estate. For those of you that were here last time, we've had a presentation on the future of work, and commercial real estate was actually something that has been discussed and has been discussed in the context of now that we are changing our working habits, working a little bit more from home, or a little bit more, some of you work a lot more from home. How does that change commercial real estate and prospects of commercial real estate? Then we've discussed this with Rudolf a little bit, and he's made very many interesting observations that come also in light for the future of this important industry. So we are here today to discuss that with Rudolf Němec, who is a partner and capital markets director. Is it director? Yes, at Cushman and Wakefield. And he is in commercial real estate and has been in commercial real estate for the past 11 years, previously with JLL. And let me just cite one thing that I've picked up from the Cushman and Wakefield website that I think goes to show Rudolf's expertise. Throughout career, him and his team have orchestrated transactions totaling over 1.6 billion euros. So I think that shows you that we have a right person for the job and for the discussion. The way that we will structure the discussion today, we will have more or less an hour presentation, but I mean, I'll leave it up to Rudolf if he wants to talk a little bit more, a little bit less. The rest of the time is for you to ask questions, and then there's also an opportunity for networking. So if we wrap it up early, please feel free to help yourself with some snacks and coffee, which was something that last time, the cohort that was here last time requested to have networking with snacks, so we've delivered. You can also see a QR code that is for Mentimeter. We will be then asking you for your feedback right after the presentation, so please do not leave. And you can also use Menti to ask questions to Rudolf that we will then proceed with, but we can also do Q&A the old-fashioned way. Okay. If there are no further questions, then Rudolf, the floor is yours. Thank you very much.
Thank you very much. Good afternoon, everyone. Thank you to the National Bank of Slovakia for inviting me and for having me on this floor in this beautiful venue. It's my first time here, so I'm really impressed that it looks really nice. When I accepted this invitation, I did not really know who is going to sit in the audience, and that is quite important for me to know because I can then adjust the way the things that we are going to cover in the next 30 to 60 minutes. It won't be that long, I promise. It's only real estate. It's not a rocket science after all. So just a very simple questions. Can you please raise your hands if you have not come across commercial real estate before? Okay. Can you please raise your hands if you actually, or if you do something with real estate? Okay, so it's half and half. All right. Good. So for the sake of this, I will start quite easily by saying what is commercial real estate. When my grandma or my grandfather asked me like 10, 11 years ago, so what do you do? And I was like, hey, I'm selling real estate. And I told them then what I'm actually doing. But every time someone asks me on the street what I'm doing, and I say I do real estate, people start talking about apartments and that they need to rent a 2-bedroom apartment in Petržalka and what the rent should be, etc., etc. And usually I say I have no clue, you know, because it's not what I do. And they are very surprised because I think that in Slovakia, commercial real estate sector is completely overlooked. There's an exception, you know, few individuals in the banking sector, in the real estate sector. If there's a nice bash somewhere after some awards or something, it's one room of people. Maybe, you know, if we are lucky, it's 150, and that includes really everyone. So it's a small business in Slovakia, but it is a really big business elsewhere in the world. And I was told that I have to press something. So when, you know, so what I do is that I advise, and I've been advising clients, either buyers or sellers, on the acquisitions or disposals of commercial properties. So because Slovakia is small, we cannot really focus only on one asset class. But if we look at what real estate investing actually is, we can look at this chart. It's 4 quadrants of real estate investing. There are 2 important variables, that is direct and indirect investments, and either equity and either investments in equity or into debt. Now, when we say investing into real estate, most of people think of the one on the top, on the right, because that's the direct thing, you know, like you want to buy an apartment, you go, you buy an apartment. If you were rich, and there are some people who like that, in Slovakia, they actually buy directly a shopping center, you know, like Eurovia is owned by a private individual. So that's part of the commercial properties. Of course, you can also own an apartment in High Tatras and rent it out. It's investment, it's direct investment, and you can also own land and wait, and finally the land will maybe gain some value. So that is what is the usual thinking, what is real estate. But also there are other ways how people can invest into real estate, and that is when they go indirectly and they actually go through the real estate funds that are the case in Slovakia, or REITs that are the case in abroad. They can invest into funds of funds. So, for example, if like there is a person in this room who is actually running a real estate fund, so he knows really well what it is about. So, like, people pull together money, they put it into the fund, and then they buy commercial properties. If someone wants to diversify, they invest into a fund of funds, so that the diversification is greater. It's the version of the mutual funds. There's also a case of crowdfunding now. Even in Slovakia, it's called Crowberry, and people pull to money, they develop a real estate project, they sell the apartments. And of course, there are private equity vehicles. So private investors pull together money, form a limited liability company or a share company, and they buy properties. If we look at the equity investments and indirect, equity, indirect investments into equity, that is something that you cannot do as a private individual that easily. But this is specialization of institutional capital. So you can so the capital can finance private mortgages. There can be a seller financing. So a company owns property and they finance the debt for the purchaser. The usual case in Slovakia is senior loans, sometimes junior loans, and then of course mezzanine and equity. So the mezzanine is the most risky for level of capital. And then there is something that is not really the case in Slovakia, but it is very common in abroad. What we have here is real estate notes or bonds. Maybe you have seen that when JNT was developing Eurovia 2 or Penta was developing Sky Park or Proxenta is developing whatever they are developing, they issue bonds and they are linked to the project. It would be better if they were also secured somehow, but I checked and they are not usually. Then you have real estate debt funds, so that you can actually invest into the fund that specializes in debts. And then you have mortgage-backed securities and commercial mortgage-backed securities. I believe there are only a handful of people who know what is that. It is a very tricky and interesting thing because, in my opinion, that the CMBS was the cause of the global financial crisis back in 2008, when the toxic mortgages were pulled together into a nice package, wrapped by a very nice bow, that's usually my job, and sold to big investors through the investment banks. They had great credit rating from S&P or Moody's and Fitch and all these agencies. So it worked until it didn't. And now the commercial mortgage-backed securities, I just read the article yesterday, are coming back into fashion. So we can be looking forward to the round number 2. But when we are talking about commercial properties, first and foremost, we are talking about four types in Slovakia. That is office buildings, shopping centers, or let's say retail, which includes shopping centers, retail parks, department stores, any form of place that you are selling something in. Then you have, of course, industrial properties, which include some storage facilities, warehousing, light industrial halls, etc., and hotels. In the bigger markets, residential, the build-to, or let's say residential leasing, multifamily is a very popular investment class where up to 30% of the investment volume actually goes into residential sector that is institutionally owned and rented to private individuals. That is not the case in the post-communist countries because people here were partially lucky, partially unlucky, that they actually got the apartments for free, and that's why we have like 95% ownership ratio, and people are not forced to rent apartments that much. And of course, there are alternative asset classes, which includes very popular now and high in demand data centers. There is a huge demand for assets like this. Living sector, which includes student houses, elderly living, and also photovoltaic panels and wind turbines and the sea, which of course we do not have in Slovakia. So that was like a very short intro, but let me explain what the real estate universe, or who are the actors in the real estate universe. The parties at the bottom are interconnected. The two parties at the top are the kings in this play. The one party is the EU and the national governments, who can set the legislation framework as they want. They set the rules. They set whether REITs structure can be in Slovakia or we have to have normal like real estate funds. The EU sets the targets dealing with sustainability. The rules are set who and how can invest into what vehicles. So it's a very complex topic. And the ECB or the Fed in the US or the Bank of England in the UK are very important in determining the most important thing they can do is playing with the interest rate. I think that last week a lot of people were happy because the ECB cut the interest rate by 25 bips. And everyone else is just hoping that they will do another 50 by the year end. We've been waiting for this for quite a long time, and I will show you the chart of market inactivity. But at the bottom part, you have the equity investors, who are the actual people who have money, because someone needs to have that money. Money managers, so that's all the institutional or private equity managers, capital. Basically, someone has money, and you know, you cannot go and buy a building for 150 million euros. So we just park it somewhere, and the money is managed by money managers. We also call them asset managers as well. Then we have lenders, and this usually includes the financing banks. But as we seen here, you know, you have several options how to invest into debt. So when we are saying lenders, it does not include only the banks. And then we have occupiers, so someone actually who is supposed to use the building, or at least pays the rent for that building. And then we have the developers, without whom there would be no real estate market. And we need them because it's a tricky, risky business. And when the development segment is doing well, the entire country is doing well. When the development halts, something is wrong. And there are like 6 battlefields from this. So when we are, or the areas that we will explore is basically planning and developing, leasing and occupying, financing and refinancing, holdings, like owning the asset and managing it. And then either buying or selling, so I investing or divesting. And then there's ESG or EU regulations. That is a whole separate thing that's going to influence a lot of things, or basically all the 5 other parts. Each of this segment has different challenges and new trends affecting the investment stage. And I was told that you want to cover the trends in commercial real estate sector. So I did not focus the presentation on what is the vacancy in what district and which buildings were delivered and which are in pipeline, because that's not really a trend. That's like the market intel. But let's look at the very big issue now, which is ESG. 3 letters that are everywhere now. You've read it in the newspapers. You saw it on the internet. It stands for environmental social governance. So 3 words, quite broad meaning. Every part of it means something else. So the ESG sets the rules with regards to real estate. Oh, I'm very sorry. Just my client was calling. All right, so ESG stands for the environmental part. So with regards to real estate, we are looking at how to make real estate more efficient in terms of energy consumption and in terms of CO2 production. In terms of social, how to make the commercial real estate sector more social in a way that we include all the people. We are trying to source local materials, local providers. We try to be inclusive, etc. We try to use or basically provide usual infrastructure so that the commercial properties are working for people. And with regards to the governments, well, there is also other set of rules specifically linked to commercial real estate, so that altogether, basically, it sets a framework through the regulatory standards and certifications and initiatives. So the EU has been quite active in this area and has been trying to push on the environmental agenda. Maybe you've read in the news that now the Green Deal is in danger because the Green Party did not get so many EPs elected in the new parliament. So it is true that this is quite highly political topic that is being pushed to the business. There are 5 most important regulatory frameworks that are valid, that are already implemented, and are in practice. So the EU taxonomy is the famous Paris Agreement or the Green Deal initiative that has been valid from 2020. It clearly establishes targets for decarbonization of operational real estate. The system will start to work in 2030, and by 2050, it clearly defines a line how the emissions produced by the operation of commercial real estate need to go down. The targets are defined for every EU state, for every asset class, so that you can very easily check where your property needs to be based on proper audits. The second aim of the EU taxonomy is to achieve energy efficiency, so that again it tries to minimize the CO2 production and well, almost to the point where by 2050 it will be zero carbon for the buildings. We will talk about it later. But there's also sustainable finance and disclosure regulations that is actually required by the EU for all the funds and large investors. But basically, if there's like some investment vehicle, they need to report according to these regulations. There's also Corporate Sustainability Reporting Directive, which sets the targets to basically all the large companies, either defined by the revenue or by number of people, so that every company needs to monitor its carbon emissions on the level 1 or 2 or 3. There's also Construction and Demolition Waste Directive, which is going to be in place from the January 2025, and it sets a way how old buildings can be decomposed or demolished. And basically the rules are that 70% of the waste produced from the building by weight will need to be either reused or recycled. And that includes 6 categories from glass, wood, metal, gypsum, minerals, and I forgot the 6th one. So from the next year, it will be much more expensive to actually tear down a building. And then there's Energy Performance of Buildings Directive. I think that you know that. If you go into your block of flat or your house, maybe you have that little sticker with A, B, C, D, E, S, and it goes back to G or H. So the EU approved that in 2010, but they forgot to implement the same measurement system and methodology for the entire EU. So every country did a different, or implemented the directive differently. So from January next year, there's going to be a one single methodology of how to prepare the EPCs certificates, and they will be unified. Well, why I'm saying all of this is because 40% of global carbon dioxide emissions is coming from commercial real estate. So the EU is very progressive, and they made a choice. And this is hugely affecting commercial real estate sector on really from the financing point of view, tenant point of view, investment point of view. So that's why everyone now is looking at CRREM analysis. So what is CRREM? Well, basically that's a system, or that's a methodology, how you can measure the CO2 production per square meter of leasable area per year of commercial property, and you can put the dot where your building is on that pathway, on that maximum that is allowed by the EU taxonomy. And the same can be done with CRREM with the energy efficiency, so that you can basically put the dot and see, okay, my building is going to be okay until 2035. So I have plenty of time to prepare the building, to prepare my investment. The thing is that most of the buildings are not prepared, or actually are not okay, because they were above the limit back in 2020 maybe, you know. So a lot of investors now is actually doing this, and a lot of companies, potential tenants, are asking landlords to provide this information, because sustainability, this corporate sustainability reporting directive basically requests them to calculate the emissions, and they don't want to have a high emissions, and they made a decision that they will not be sitting in buildings that are not zero carbon from, I don't know, 2030. So now these top tenants, all the investors want to have in their buildings, are actually looking at the options of where to move their offices, how they can do it, because they want to minimize the CO2 productions that they will need to report further. And there's also the, as I said, APC certificates. The difference between Carbon Real Estate Monitor and APCs is that the APC is theoretical, based on the data provided by the theoretical consumption of the technology, whereas CRREM actually takes real measurements into account, and that it puts into the model. And there's also GRESP real estate assessment, and that is a certification that is required by larger investors for portfolios, so that you can calculate everything on the portfolio or on a platform value. The important outcome of this is that ESG is not optional, even though some people don't like it. But to be honest, it's a big business, you know, like it drives investment into real estate, it drives new construction. So there is a huge debt associated with future investment that will need to be spent on commercial buildings, because it will be required. They will either adjust or they will be not successful on the leasing market. So when we are talking about the reporting standards, of course, the investors and companies need to report. So from my experience, the Global Reporting Initiative is the most common one that I came across. So do you think that, is there any future for buildings that are not green? If you agree, raise your hand. Okay, so my colleague raised his hand, so I'd like to know why he thinks that there is future for buildings that are not green. 6 years. All right, that's true. But the usual implementation phase of turning a non-compliant building into the compliant building is 5 years. So everyone should start panicking now because it's going to be late. That, that is a very good question. If I'm not mistaken, the UK targets were set to 2025 and they decided to move it to 2030. So they aligned it with the EU. Germany, on the other hand, they implemented the carbon tax policies much sooner, so they are already in practice. So I say important thing that what happens if your building is above that permitted line of CO2 production, well, you will start, well, not you, but the owner of the building will start paying taxes, new carbon taxes. It has not been decided what the tax will be. That's on each individual EU state. In Germany, they started with, I believe, 35, then 45, then 55, and in 2025 they should introduce a 65 euro tax on 1 ton of CO2 produced. And the idea is that it will be put on a stock exchange. Basically, those who need them will need to buy it from the stock exchange. That there will be limited supply. Now, how that is going to work in Slovakia, I think we have different focus currently in our country. But the idea is that that there will be a carbon tax from 2030. And most of the buildings are not currently compliant. So, the CEO of my past employer said that, and it's like multi-billion dollar company. He said that there is no future for buildings that are not green. So I'm not in that position to say that because I want to be selling something or some of those buildings that are not green. So I'm not going to go against me, but they will definitely need to be repositioned and heavy investment will need to be spent. If not, they will become obsolete and they will become not financeable by the financing banks because they usually require like B2C grade on the APC certificates, and they will try to be more demanding when it comes to the CREM positioning, etc. So there's a huge opportunity for repositioning of the buildings, and what we are seeing now is that, and actually one of the key trends, and I will start with offices because I think that is most relatable. I believe that this building has 60,000 square meters, and I ask how many employees work here. So it's 750. If everyone is at work. So, but I believe that even this venue is included in the 60,000. So it's not that generous, but still, the average area per head is like 10 square meters, and now companies are actually realizing that okay, not everyone is really going every day to work. I think that you had this talk before. From our research, that like we have access to really companies around the world. So we did a proper research with hundreds of companies, 70 million employees, so huge figures. And it turned out that after COVID, the office usage or office occupancy levels is like 45%. So people are not using the office as they used to. And 63% of the occupiers want to further reduce their area they are using. And they want to reduce by 25% or more. So there is a huge question mark when it comes to the investments into the office sector. Which buildings are going to survive and which buildings are going to become obsolete and empty, and it will be actually expensive to demolish them as well because of the new directive. Also, companies are trying now to use the space better. So they want to increase the area for collaboration. They want to spend or dedicate almost 50% of the area for the internal meetings and some relax zones, collaboration zones, etc. And companies see that office is important. Like I remember that when the COVID hit, everyone was happy because we had home office, but it was okay up until some point, and then we realized, okay, it's actually nice to go outside of your apartment, to have a place to go to talk to your colleagues, to create a team. Some companies that are completely remote, they need to substitute this by expensive team building. So they take the entire company on a week-long team building and they create or try to create those relationships there. But the overall outcome so far is that those office buildings are important, but companies want, or those companies that are at the top, they are high-quality companies, they want high-quality spaces in the best buildings that are zero carbon, and they want to minimize the area where they can create the collaboration space. They want to be in the best locations, and they want to use that space as the magnet to attract the talent for into those companies. And as I said, the prime tenants, the best companies, seek and they need ESG compliance. So that is a driving force behind what is, maybe even in Bratislava, I would say that building new offices is a challenging business plan. And normally, probably, it would be delayed given the current circumstances and situation on the market. But there is demand, and the demand comes from these companies who need to move, who need to go into the new offices that will be not carbon neutral, but zero carbon. So they will not be needing offsetting or buying offsets, some sponsoring a forest in Brazil, but actually those buildings will be zero carbon, or thanks to the technologies, they will be able to take out the carbon out of the atmosphere. And the other areas, as we had, is like bubbles, like who are the players, what are these factors, is the financing. Of course, ESG again plays role, but I think that I covered that. Now banks are requiring, as part of their due diligence, some sort of ESG strategy, because not all the buildings and most of the buildings are not ESG compliant. But those financing institutions want to have clarity that there is a plan how this will be taken care of, when something needs to be done, what needs to be done, how much is going to cost that. Does this investment into the new technologies influence cash flow? Is there a proper debt service cover ratio? So all the players in the financing market, they build their own ESG teams of experts who are assessing those buildings, are asking the right questions. But overall, in the light of the current situation in Europe, financing or refinancing has become more difficult than it was. Of course, on one hand, when the times are harder, the pool of potential lenders slightly shrunk, so we don't really see that much German banks or Austrian banks in Slovakia. Rather, the locally present brands of international banks. So we see that the most active players are Tatra Banka, SLSP, ČSOB. But if the threshold is larger than, let's say, 30, 40 million, it needs to go to their headquarters in Milan or in Germany for approval. And of course, the conditions are tougher than they used to be, basically in all parameters. So that puts additional pressure, and that is something that really influences the markets everywhere, especially when the business plans were built on cheap financing and the term is coming to an end, and those investors need to refinance. And basically, if you buy property that yields 4% or 3.5% in Munich, and then you want to refinance, and suddenly financing costs 5%. Well, that's an issue because you have a gap in the cash flow. So there are a number of ways how investors or asset managers, money managers try to find a way around. One of the way is to look at the interest rate swaps. So a longer term hedging helps to bring the cost of the financing down. Some of the investors are using that momentum. It works sometimes it doesn't. But to be fair to say, everyone was expecting like a huge fire sales like investors were holding money to wait and grab the opportunity when it will be sold in a fire sale. And it's not really happening on that scale that everyone anticipated at the beginning. So we cannot say that there's a panic on the market. If there's a problem, it is taken care of very rationally and professionally. Of course, there have been value or price adjustments. We'll cover that later, but there's no reason for panic. So when it comes to the holding and managing, so imagine that, I do not have a fund, so I'm not a fund manager. Maybe someone else in the audience could put more light on that. But in general, there has been a general repricing of properties in Europe between 20 to 40%. Those markets that were really hyped, like the central Paris, Munich, London, where the yields were extremely low, saw a price correction, in the area of 1.5 to 2.5%. If you do that in those markets, the values are going to be slashed really by 40%. If you do 1.5 to 2% adjustment in Slovakia, it doesn't mean 40% because those yields were higher. So that it helped us to save the values and the fund performance a lot. On the other hand, my colleagues from valuation department would not be happy, but I do see the difference between the value and the worth for investors. So the value is let's say a longer term value that you would obtain on the market as of the moment. However, there is this shadow area if the market works well, and basically if there's a willing buyer and a willing seller, if the parties are knowledgeable. In the times like this, you could not really find a willing seller because everyone was trying to get that bargain. So there was a difference, a huge gap between pricing expectations from potential sellers and from potential buyers. And those price expectations were really like 200 bips sometimes. And that is why the Central European market became quite illiquid. On one hand, it would not be right to slash the values and basically punish the investors and hand the funds by saying that the value of the properties are down, because that would not be really case. On the other, you would not be able to find potential sellers for the pricing that investors were looking for. So this gap is currently narrowing, and hopefully it will meet at some point in this year, so that we will get into the pricing equilibrium. As of the moment, the core markets in the Western Europe has been repriced, and it is maybe coming to a lesser, or this slightly, that the prices has been adjusted in this area as well, and will be further adjusted probably in the next two quarters, unless some deals will prove otherwise. Because of the uncertainty of the market, there was a trend of, especially in case of retail open-ended funds, investors trying to get money out, because they were in panic and they thought that they're going to lose their money. So some funds had to close the funds for withdrawals. I think the best known case in our country is the HP Ravis fund, but it was actually a fund of qualified investors, so there was a slightly different case. But investors, and maybe in Czech Republic as well, investors were panicking a little bit, and funds had issues that they had to sell some properties at a discounted value because they needed to create that cushion, that pillow of cash in case something was needed. And of course, all the asset and holding managers need to get ready for ESG, because that will punish their performance, and they need to get prepared. So those funds that specialize in all the buildings will need to work twice as hard to prepare themselves for 2030. This is the chart showing investment volumes in EMEA, and you see that we were very happy in 2019 and 2021 because the market was booming. The money was cheap. I mean, everything was all right. You know, like I actually started working in real estate in 2012, if I'm correct. So I enjoyed that enormous rise, and it was great. And when you ask older people, so what do you think about what is happening? You know, people who are 60 and more, they will tell you that, you know, I've seen happening this so many times in my life. It happens like every I don't know, 8 to 15 years. There are these property cycles. They are not the same everywhere, but basically this is like a normal thing. So don't panic. It will take some time, maybe a couple of years, but it will eventually go up again, and it will be all right. However, if you look at the 2023, you see that the investment activity really bottomed. It was not as bad as after the global financial crisis, where the market completely collapsed, but the situation was different this time. And there were different arguments why this happened. There was enough liquidity this time. There is a lot of dry powder available. You know, like I've searched the numbers, and it really differs from 2 to 3 trillion US dollars. People who work in banking knows how many zero that number has. I do not. But it is really a tremendous number, and the question is like where is the dry powder? Because it wasn't put into real estate. Everyone was waiting for it to happen, and it did not. but when you are investing or divesting, you have to take into consideration the property cycles. And basically, currently, while the trend is clear, it's a good time to buy if you can get the permissions from your investment committee, because people and committees are cautious. But you have to take into account the bid and ask disparity, as I said. You need to find a common ground for both parties, the deal to work. There's a clear preference for, again, zero carbon products. So those achieve either premium, or those who are not zero carbon, they do achieve basically discount. There are special funds that specialize in green investments, so like ESG compliant investments. There has been a case of a greenwashing. I think it was 2 years ago, when Deutsche Bank had some investment vehicle focused on green investment, and it turned out that it was not. And then the police raided the office of the bank, and then they did a proper due diligence of everything. It turned out it wasn't that green after all. But there are specific directives of the EU, again, that basically say that if you meet these requirements, it is green according to the article number 6 or 8 or 9. Of course, the article number 9 is the most green of all, and it's quite difficult to meet. So there's a framework that some funds specialize in, and there's a clear trend. On the other hand, there's also a clear trend now from investors to look into value-add investment opportunities. So discounted pricing, but they roll up their sleeves and they try to either reposition the assets, change the usage, put it back on the ESG track. And for all of this, investors need capital. There has been issues with raising the capital recently. Now the situation has improved a bit, but still there's a lot of liquidity, but it isn't necessarily put into the money managers' hands to be actually put or placed on the on commercial real estate market. When we are talking about Slovakia, like I was asked to talk about trends in real estate, and for this we are not an isolated island. So let's put Slovakia into the perspective. You see that this is the overall pie chart of European investment by region. On the best year, it's roughly 350 billion euros annually. But you can see that the DACH region, Germany, Austria, Switzerland, has 1/4 of it, approximately. Then UK has another quarter. And then France, then Benelux, the Nordics, then Southern Europe, and then CE is 4%, and the CE actually includes, like Poland, Hungary, Slovakia, Czech Republic, sometimes the SEE country as well, that are put into some deals if they happen in the Baltics countries. So basically Poland is 50% of the CE region. So Slovakia is around 0.7, 0.8% of the European investment volume. So in my perspective, whatever happens in the core markets will at some point eventually, with delay, it takes sometimes years, but it will arrive to Slovakia. So if we see new trends happening in the UK or in Germany, or actually it happens in the US first, and then it comes to the UK and then to the continent Europe, and then after five years plus it comes to Slovakia finally, maybe even more. So that is where we are. However, like the capital markets overall globally is currently in the phase of transformation. Let's say 3 core asset classes, industrial, office, and retail, have experienced quite significant turbulences over the past period. Industrial, 10 years ago, no one really wanted to invest in industrial. It wasn't sexy asset class at all. It was just shed. It was specialty niche business of some investment platforms or very like specialized investors and developers. It's still the case now, but now almost every investor owns industrial and have that in their portfolio because industrial sector has become the bone of our society. You can live without office, but you cannot really live without goods coming through the warehouse that you need for your daily life. So industrial really has become the core investment strategy for almost everyone. Retail was extremely popular a couple of years ago. Then it became quite expensive. It fell out of fashion from institutional investors. And now the interest is coming back strongly because there has been a repricing where the returns are again interesting. So when the money managers can report double-digit returns in terms of cash on cash or IRR, they are really looking at retail and it makes sense for them. And especially retail parks are really popular, as well as prime shopping centers. And offices are currently in this area where everyone keeps questioning them because of the reasons I mentioned. It's not really clear how much space you are going to need or what buildings you are going to need unless you have the super prime zero carbon. Selling offices, also prime older offices, older than 10 years, it's quite difficult this time of the cycle everywhere, whether in the US, whether in Europe, and also in Slovakia. But investors are looking again at these older, more opportunistic buildings that could be turned into something else. That's the same slide. That's funny. And looking at the more alternatives, hotels where, interestingly, during the COVID period, hotels were, frankly, a horrible asset class to be invested in. But they are back in fashion, and they were the only asset class that experienced increased investors' activity last year and in 2024. And the numbers are working well. Investors are happy about it. And the same applies for living, where 7 years ago the share on the investment volume in EMEA was like 7%. It was really like this niche business. No one really wanted to go into that. But together with industrial, it's basically about beds and sheds. You need to sleep and you need to eat. So basically, these two asset classes are super resilient. So the usual share on the investment volume now is 25 to 30 or 35%. It oscillates really around that area. So and in the next 5 years, it is estimated that every year up to 85 billion of euros will be invested into own to rent or build to rent multifamily or student housing or elderly living investments. Unfortunately, we are not really going to enjoy that in Slovakia because we do not have the framework. We do not have the legal framework. We are completely unprepared. Even though it was in the newspapers, in the headlines, in the past few years. I haven't seen many apartments being actually built. And when I attend these conferences, either in MIPIM in Cannes or Expo Real in Munich, I talk to these investors. I talk to the global funds that would be willing to invest here or to German funds or to private equity money. And they would be open to do that in Slovakia because they are in Czech Republic, they are in Hungary. It makes sense for them to come here because we are a Euro country, but it's difficult. Plus all these investors require like 5 to 6% return, and it's very hard to compete against private individuals who buy apartments and rent it out. They are not really paying taxes on the rent that they are charging because they are taking cash, and people are happy with less than 2% return on their investment. So that is destroying this part of segment or sector in Slovakia. Alternatives is a new trend across Europe and in the US. So research and development centers and laboratories. That's not really the case for Slovakia either. And green energy would be interesting product as well. There's a lack of it. Our colleagues, actually we have a specialized team for green turbines and PV panels, but there aren't really a lot of opportunities in Europe, but there's a strong demand for that. So when it comes to the trends in Slovakia, investors are really reviewing their strategies and they are cautious. And see capital plays a dominant role. In the past, it used to be the case that foreign capital from Western Europe or global capital or from the US or South Africa, Israel, made about 70% of the total investment volume and 30% was domestic capital. Now the table switched to the extent that almost everything is now C capital, because when the markets are tough, the foreign capital keeps in their home markets. Luckily, we have a strong base of institutional investors here, and funds and money managers from Slovakia, from Czech Republic, from Hungary, who are keeping or saving the, I call it sticky yields, because yields in Central Europe haven't really changed as much, as I said, like currently in London, in city, you can buy an office building for, okay, it's not the official valuation, but you can actually buy an office building from the willing seller at 6%. And that's a good quality new building with tenant. And in the UK, they sign leases for 20, 30 years. In this part of Europe, we sign leases for 5, 7, 10 years. But our official yield is 6.25, so there's like 55 bips difference between City of London and Bratislava. So I'm just keep asking that, so because the local capital is strong, and they are operating in the Central Europe mostly, the pricing is kept at this level, and maybe the one outcome the trend that we are seeing, unfortunately, is that politics keeps Western capital away from Slovakia. I was very surprised by the number of investors from the core institutional investors from Western Europe asking me, so what is happening in Slovakia? I read this, I read that. So the situation is not really help us. The headlines are really destroying the liquidity of the markets, and we are the one to blame. But looking at the overall perspective, like what investors are planning to do, what are the key trends? So you can see that actually almost half of the funds that INREF talk to want to reduce their exposure to directly held real estate. And on the other hand, 84% want to increase their allocation to not listed real estate debt. And you see all the asset classes, and And it is really interesting to see that investors are backing away from the traditional direct investment of going and buying a building to rather going into JVs and club deals, some separate accounts, non-listed debt. And when we look at the allocations plan, we see that in Europe, actually, investors want to reduce their target allocations to real estate, whereas in the Pacific, in Asia Pacific and in North America, they want to increase. So this will have additional impact on the market liquidity, and the trend is quite clear. As I was saying about this this interest of investors, what they want to do. Investors are changing their behaviors, and we did, like if you look at the research from Handel latest was in December 23 compared to the year ago, you see that the funds of funds is the choice number one because it provided the investors with immediate diversification and risk reduction, spread of risk across many properties. And then secondaries. Secondaries is an interesting product where you have some sort of structure where investors are locked in and they need out, they need some equity. So they find an investor or the investor finds them and they are paid out of the structure at some discount. So these like a value-add speculative investment strategies that we see is what investors are opting for. And I'm sorry but that was my last slide, but Hiva was showing me like time. So hopefully I was not boring you, and I'm ready for your questions. Thank you very much.